Hey everybody, welcome. This is Tucker Balch. I'm Chief Scientist at Lucena Research, and today we're going to show you how at Lucena Research we build custom strategies, what our workflow is, where we get data from, and how we pull it all together into a working strategy. Now just to peek ahead a little bit, this is where we're going to end up. This is a back test of a strategy that we created here at Lucena. The orange line there shows the performance of the strategy, and the blue line there, a little bit lower, is our benchmark, in this case S&P 500. Yes, that's strongly performing. Some of you may be wondering, is that in sample or out of sample? Well, we'll get to that later, but I can tell you that most of this is indeed out of sample. You can't do everything out of sample, but we take certain precautions to ensure that the back tests we have are representative of potential returns. But like I said, this is where we're going to end up. I'm going to take you now step by step how we build strategies like this. First, I should tell you about what Lucena Research is. We're a fintech startup based in Atlanta. We've got a number of products. One of them is QuantDesk, which is our flagship cloud-based product that we use to design these strategies. We also license model portfolios, and we develop custom strategies like the one I'm going to be showing you today. I'm joined here by two of my colleagues, Taylor Korf and Richard Brooks. Let me tell you a little bit about myself. I'm a professor at Georgia Tech, where I teach courses in machine learning and finance, but I'm also chief scientist here at Lucena Research. And I'm joined here by Taylor Korf. He's a Georgia Tech graduate as well, with experience in the aerospace market, but he's been here as a quant for us for several years.
Hey everyone.
And also Richard Brooks. He's got a graduate degree from Georgia Tech, and besides his time here, he's been in the financial markets in a couple different ways, including Deutsche Bank, and also work at a hedge fund.
Hello.
You can be more talkative later on, Richard, I think. All right, so we're going to present a three-part series. It's really too much to cram into just one talk. We're anticipating that what we're going to talk about today should run about 30 minutes. We have the ability, of course, to go a little bit long, but we want to keep it short so we can keep your attention. But we're going to follow up in 2 weeks with another presentation drilling into the details of backtesting. And finally, the last presentation will be how we refine and deploy these strategies. Today, we're going to focus on initial research and data. And in particular, we've been working with a data provider, Dorsey Wright. They've got a very well-known history, and we've invited a representative, Ben Jones, who's a senior analyst at Dorsey Wright, to tell you a little bit about their data. Then we're going to show, given a data source, how we can find the best ways to use it and what other data sources you might combine with it to create a strongly performing strategy. Now here's sort of a block diagram of what we do here at Lucena. We take in many, many data streams, and that's represented by these little pieces of pie there. We've got technical data, fundamental data, macroeconomic data, social sentiment, news feed, insider buying and selling information, corporate actions, several others. And we track thousands and thousands of assets worldwide every day. We ingest all this information every day. It's millions of data points for all these thousands of assets. We then turn loose machine learning and other analysis techniques on that data to build these strategies. And today we're going to focus on one piece of that puzzle, namely Dorsey Wright and the data that they provide, and we're going to explore how we can make use of it. Now I'd like to hand things over to Ben Jones, Senior Analyst at Dorsey Wright. And Ben, I'll get your slide up there in just a moment. Okay, Ben, tell us about your company and about some of your indicators.
Beautiful. Thank you so much, Tucker. Again, my name is Ben Jones. I'm one of the senior analysts here at Dorsey Wright & Associates. We are a technical analysis research firm based here in Richmond, Virginia. We were founded in 1987 by Tom Dorsey and Watson Wright. Our research is built around the point and figure methodology, which Tom Dorsey is known for resurrecting about 30 to 35 years ago. Our mission as a firm is to serve financial advisors, money managers, and investors all around the world through our world-class research and charting platform. And we do that using a methodology that dates back to the late 1800s. Over the years since we were founded back in 1987, our firm has evolved in the types of tools and capabilities that we offer. Whether it's models and reports that are available on our research platform or our money managed tools and solutions, whether it's an SMA or mutual fund, or even indexes that are the backbone of ETFs, we have been serving investors through this basic methodology, yet a robust methodology, point and figure charting. What's also really neat too is that back in January 2015, all of our work has been validated by the acquisition where NASDAQ acquired Dorsey Wright in 2015, and we are essentially trying to help NASDAQ further their position as a leading smart beta index and financial data provider. So how do we fit in the pie at Lucena? Well, we're going to be part of just the Dorsey Wright data feed as well as the technical feed, because that's essentially what we are. We're a technical analysis research firm. And if you go to the next slide, you can see exactly what our research is based upon and what the data feed looks at. So our research uses the point and figure methodology. This is a form of charting, technical analysis charting, that was created by Charles Dow, who was editor and founder of the Wall Street Journal, as well as one of the co-founders of the Dow Jones Company. He created this form of analysis or charting initially as a logical, organized way of recording price action. So at the end of the day, essentially what this chart tracks is price, which is essentially tracking the imbalance between supply and demand. What you see in front of you are two basic signals, a double top and a double bottom. Those give you an indication of whether you're seeing a confirmation of rising price or falling price. And what we simply look at is the X's and O's. X's price is rising, O's price is falling. Again, it's just a way of tracking price over time. As Tom Dorsey once said, it's the most simple method to understand but the least used. So when you see those X's, that's what a point and figure chart is signaling. As price is rising, O's price is falling. We see that little green B there on the double top, that's a buy signal. That just represents what you're seeing exceeding price levels above a previous level, which is a classic technical buy signal. One of the unique aspects of point and figure analysis is that time is removed from the equation. So if you're familiar with other forms of technical analysis, whether bar charts or line charts that incorporate time, point and figure charts do not. What's significant is price movement, which really is another way of saying that on a point and figure chart, volatility is the key driver for plotting the chart. A stock that exhibits large price swings or large moves relative to the market benchmark will change columns, will move to signals. So volatility is, in a sense, embedded in the chart. So at the end of the day, the point and figure chart provides an objective means for analyzing price movement across multiple asset classes and regions. It is also well suited for quantitative testing and machine learning because you're essentially looking at signals that are quantified and stored in databases. And it's also an amazing methodology that it can be used for testing that really traces its roots back to the 1800s. And that's why we're excited about what Lucena Research brings to the table today, because of course they are leaders in the next frontier of quantitative research, whether it's through machine learning or predictive analytics. And we believe that combining their testing methodologies and capabilities with a tried and true form of charting, point and figure charting, that traces roots back well over 100 years can really give you a powerful solution for your investment decision-making needs.
Ben, thanks a lot. A couple things I want to mention. Folks who are online watching, please take advantage of the question tab. We're definitely interested in answering your questions. And Ben, I hope you remain on for the Q&A session at the end. So please, everybody, ask your questions. If we have an opportunity during the presentation, we'll be glad to answer them. And again, there'll be a question and answer session at the end. And any questions that we don't answer on the broadcast here, we'll follow up with you individually after the broadcast. Now, wanted to talk about one of our most important technologies here. We call it event study technology, and it's the way that we process the Dorsey-Wright information, along with many other indicators that are part of our system. So let me first tell you what an event is. So you're certainly familiar with stock screeners or stock scans, and that's where you describe to a system, okay, I'm interested today to see which stocks have momentum, which stocks, for instance, are indicated by the point and figure chart, and other factors as well. Now you can build a scan by describing, okay, I want this factor to be at this level, and I want the other one to be at this level, and find me all the stocks that pass that screen today. Well, that may be very useful, but what it doesn't tell you is how that event description would have worked for you historically. And that's what this event study is about. So you can think of an event definition, that stock scan I was talking about, it's kind of like a funnel. So every day we look at all the stocks that we track, and only a few sort of fall out of that funnel or meet the criteria for that scan. And by the way, I'm going to use interchangeably event definition and scan. Anyways, on any particular day, maybe one of those stocks is identified, and that's the first step in this analysis. But what we do beyond that is we go back in time, and we have historical records of what the values of all these indicators were historically. We go back decades, and we can test, hey, how well did that scan work historically? And so, for instance, over time, maybe this particular stock, Apple, met those criteria at these different points historically. Then what we do is we look, okay, on this particular day, Apple satisfied that criteria. We can look before and after what was the price movement. And we can do that for each one of these. Now, that's just telling us for each of these individual times what happened, but we want to look in aggregate, see if we can build a sort of model or expectation for what happens when these criteria are met. So we do that by overlaying each of those examples on top of each other. So that's what all these multiple lines here. The blue line is what had happened before the event was satisfied, and that's what the date of that when that happened is indicated by this vertical orange line. And then these orange lines afterwards show what happened after the event. We can aggregate that by taking the mean, and you can see in this example, we had sort of flat price action before the event and then positive action afterwards. And we can also look at some of the statistics afterwards and look, for instance, at how volatile it is, which can help tell us, how predictable of a signal it is. So that's how we do event studies. And let me show you, for instance, off of our platform QuantDesk, what an example event study looks like. And this one is, in fact, using the Dorsey-Wright point and figure indicator. And you see here, well, what we're looking for is a positive indication, but not only that, we're looking for that positive indication to have been on for many days. So now it looks sort of like a flat line, but it's not really. Now, coming into the event, yes, it's somewhat horizontal, but after the event after those criteria are satisfied, it grows slowly out 21 days. In fact, we see 87 bips of, and this is market relative, so this is the fancy term is abnormal returns. So we're seeing that stocks that meet this criteria during the period we evaluated them, over 21 days, they make nearly 1% return, more than the market. Now that's an overview of, of our event study technology. I'd like to pause for a moment and answer any questions folks might have about that.
So Mike DeWalt wants to know, how does Lucena incorporate point and figure representations?
This is Richard Brooks. I can answer that. So Dorsey Wright provides a lot of different signals, and point and figure is one of those. And what's usually happening is you'll get X's and O's and B and S's, which is the buy and sell signals, and then the X's and O's are the buy and sell columns. And for values like that we would call categorical, which is either one value or another, we will do something called a one-hot encoding for that. And what that basically means is we'll have a feature, or we'll represent the buy signal as a 1, and if the buy signal is not present, that means if you have a sell signal, we'll represent it as a 0. And the same is true for the columns as well. So if you have an X, we will have that as a 1, and if you don't have it, which means you have a 0, that we encode that as a 0. There are some other signals as well that Dorsey Wright provides, such as distribution charts, which basically is a trading band of a stock's price actions, and they have values that are incorporated with that, such as an overbought and oversold signal, which tells you kind of based on the historical price values how overbought or how oversold a stock is based on kind of the supply and demand paradigm that Ben talked about previously. So a value like that, which is currently a real value, we'll ingest that as it is. But stuff like signals like the point and figure charts, we will turn those into numbers by the one-hot encoding.
To everyone who missed the question, that was an answer to how does Lucena incorporate point and figure representations?
Okay, we got any questions about event studies?
Got about survival bias.
Okay, well, that's a good one to save to the end. But one thing, we don't want to be overly complicated here, but the take-home message regarding what Richard was talking about is, in the end, all the data that we work with has to be a number. It's a normalization process to ensure that we can compare against different indicators. So what Richard was describing was some of the ways that we take data that's in different forms and make them numerical so that we can work with them. Okay, now I showed you a particular event study, and that's the one you see on the screen here. Recapping, it shows that each time a stock satisfied that criteria historically, we saw nearly a 1% return over a month. And by the way, this study was conducted in 2010, so we didn't use decades of data. We just looked at a particular year, but then we took the criteria across that study and looked at a back test over many years. And let me show you. This is a back test using only those Dorsey Wright signals, the one that I just showed you. And this is going from 2004 to just a few days ago. You can see the orange line there shows a very strong return, and the in-sample period right here where we ran that event study was here in 2010. So amazing return of 586%, and relative to the market, 400%. So really stupendous there. But we're not satisfied. We want to do even better. So let me show you how we carry this even further forward by considering additional data sources. So one thing to mention is we have within our platform at least a dozen maybe 20 different data feeds, but we convert each of those data feeds, which has multiple individual indicators or factors, fundamental factors, for instance, we convert them into multiple numerical factors. So in the end, we have over 600 factors that we track on every single stock in our system, which again is both U.S. and international. We also watch ETFs, Forex, and mutual funds. But here is some of the technology under the hood that we use to improve our studies. So the first graphic there shows you an event study that's unfiltered. In other words, this is essentially just capturing all all stocks on all days with no filtering occurring at all. We can then ask the system, okay, find us a factor that might work, and we can unleash our algorithms to look across all particular factors and find those that are most predictive. So we've found one, and we can add that to the system, and that represents, for instance, the addition of one of the Dorsey-Wright factors. So here's an example, and this is very similar to the to that Dorsey-Wright factor we were looking at. And let me tell you what's going on here. We are able to indicate on this chart where we would like the system to focus. So we indicate in this orange area that we would like our algorithms to find an additional factor that is likely to select stocks that end up in this upper area. So we have some sliders over here on the platform that let you select which area you want to focus on. Usually people are looking for something that goes up, right? So we've indicated that we want this system to find some additional factors that'll select stocks that went up. We press this button, optimize, and it gives us an entire list of potential factors that we might add to improve the screen. In this case, we selected one of them and ran the event study. And here you can see we've honed it in even more specifically and found an event that finds strongly performing stocks. You know, we're adding factors to our analysis in this case. Now, let me pause for a moment and see if we have any questions about this process.
Do you want to?
So someone had an example of a qualifying criteria. So and what would create an event? And I think Tucker has some on the screen right there. But an easy example would be if you see a buy signal, or if a buy signal just started. So for Dorsey-Wright's methodology, if you have a column of X's surpass a column of O's, that will create a buy signal. And so you can create in QuantDesk, Lucena, we're able to show that an event would be what the price action would look like if you were able to purchase a stock at each time that a signal turned from a sell to a buy. And the process that Tucker's talking about as well is that we're able to layer on additional signals on top of that to filter even more. And this filtering exists in a method, a very structured approach where we're able to add signals and signal ranges such that we maximize the probability of success for this period.
Yeah, let me follow up on that by saying a way to think about it is this. Let's imagine some factors you might be familiar with, like 20-day momentum and, say, price-earnings ratio. You could define an event as saying, give me all stocks that have a PE ratio below 5 and a momentum greater than 2%. So that is specifying two criteria that together form a filter on stocks. And then this methodology enables you to evaluate the benefit of that scan. And again, you can go through this iterative process on QuantDesk to discover which factors, if added, would make it even better. Okay, now just discovering the factors or features and their thresholds is not enough to build a strategy. You need more information. And to discover that, we go through a process that we call roll forward cross-validation. And that's among other things, a protective measure that helps us avoid overfitting. But some of the factors that we need to discover to fully flesh out any one of these strategies are things like, okay, if the signal is, go for a particular stock that we add to our portfolio, how long should we hold it? How much look-back data should we use to make that decision? And there's other factors like stop loss and stop gain and so on. Here's how we discover those factors. And again, this is called roll forward cross-validation. And our horizontal axis here is time. So we roll back time to start our study. And let's suppose this vertical line, or I'm sorry, these two lines indicate our in-sample study period. So we start here and we ask our system to optimize, in other words, find the best factors and the best thresholds, and it's using this amount of look-back data. We then utilize those factors that we discover in an evaluation going forward, say a month is a typical time period. We repeat that after another month. Again, keep in mind that we're not peeking into the future. At each point here, we're looking back over this time period to gather our data and build a model, and then we roll forward for a month or several months, depending on the evaluation. Now, we may, within this in-sample period, choose to tweak certain, we call them meta parameters, like stop gain and stop loss and so on, to see how they affect performance here. But once we've converged to those parameters, we then test the approach out of sample going forward. And this is our out of sample test period. Okay, any questions for this roll forward validation stuff?
Someone had asked how we prevent overfitting by, in the case if we're using a lot of factors to define a model. And what Tucker just addressed here is a very standard approach about preventing overfitting. And the reason why is because if you have a large number of factors that define your model during your optimization phase, it might look very well. It might look very good in terms of performance. However, since you cannot control, since you're not training on your evaluation periods, it's left to whatever the future market conditions are going to do. So if you have a model that's overfit with a large number of factors, it will be expected to perform lousy in the evaluation period. And so this cross-validation is able to find models that are able to be robust over time, not just during the model fit period. And so that's how we prevent from overfitting.
Another thing to follow up with on Richard here is an important rule of thumb is that very, very complex models, in other words, models that include lots of factors, are more likely to be overfit. So we strive to have, as few factors in our models as possible, and what that means is certainly less than 10, but usually on the order of 3 to 5. So what did we discover in this work? Well, we discovered a set of Dorsey-Wright features that provide nice performance. We look at the point and figure signal, and in particular, we count how many days since that signal changed. So that's one of the factors we use. And then the other one that we use directly is that signal indicator, which is just indicating a buy or a sell. So the change days tells us how long has it been since it changed, and then the buy or sell signal tells us whether it's currently in a buy mode or a sell mode, and those two together provide a pretty effective event scan. Now we further ask the system, okay, let's use those two factors, but what other factors might go well with it? And we didn't bias it in any particular way. We just explored all the potential factors that might be available, and it discovered two fundamentals. One is Greenblatt, and you may be familiar, well, we call it Greenblatt internally, but it's based on work by Joel Greenblatt, and you can look it up. It's the little book that still beats the market. And by the way, want to plug Thomas Dorsey's book about the point and figure charting. So if you want to learn more about this group of factors, those are two books that you can take a look at. But the interesting result here is that our system has discovered that, hey, just one of these types of factors, fundamental, is not good by itself, and we can improve Dorsey-Wright. So something that's already good, we can make better. Now, what do I mean by better? Well, let me show you. So this is a back test showing the performance, which is obviously outstanding, but using only those two Dorsey-Wright indicators. Now we've got nice performance, the nearly 600% return over this time period, but we do have significant volatility and a drawdown here of 54%, which is happening here. So what if we take a look at adding fundamentals? Now, here's a back test using fundamentals only. And this is using those two fundamentals I mentioned earlier, Greenblatt and the other one. And interestingly, this one doesn't do so hot before 2009. In fact, it just tracks the market. Whereas if let me go back to the Dorsey-Wright. Dorsey-Wright has the strong advantage of performing well before the recession. The fundamentals just track the market. But after the drawdown there, we see very strong performance with the fundamentals only. So it showed you a back test with technicals only, a back test with fundamentals only. Well, what if we put them all together? Here's what we get. So we get a boost of another 180% here over the technicals only. We have a lower drawdown in this period, overall lower volatility and stronger Sharpe ratio. So really nice performance. We're seeing strong synergy here between Dorsey-Wright's data and fundamentals. So I've covered most of the topics we wanted to touch on today, and I want to remind you that 2 weeks from today, we'll have the next part of this series where we'll talk about our backtesting methodology and how we pull all this together. But I wanted to now take additional questions, and also Ben, I hope you're there. We'll throw some questions your way if we see them relating to the Dorsey-Wright data.
Sounds great. I'm still here.
Okay, great.
So we've got a couple questions on the transaction costs. So how did you specify the transaction costs? Are we including them? What is the typical turnover of the strategy we're showing?
Let's take those one at a time.
They all feel the same to me.
Okay. Go ahead, Richard.
This is Richard. Yes, we have a transaction cost model that we use in our back tests, and it compensates for slippage, fixed transaction costs, and also minimum transaction costs per share. And usually we show our back tests in terms of an example portfolio that's $1 million in size.
Anyways, yes, these back tests we showed do include transaction costs. We'll follow up to provide you the precise model there, but we include commissions and market impact. In terms of turnover, Richard actually knows the numbers on those.
Sure. So one of the things that we do in our analysis too is to try to optimize, to minimize the turnover if we're experiencing a high churn. And so the combined Dorsey-Wright Lucena backtest that you're seeing with the Dorsey-Wright technical factors and also the fundamentals has a turnover of about 120% per annum. So
120% total per year actually is not bad for a aggressively managed portfolio. Okay, Jessica, what's our next question?
Got a question. Does your model allow for predictive analysis going forward?
Yes. I mean, all of the methods I've been showing here fall under the sort of headline of predictive analysis. What we do, by the way, once we have found what looks like a good scan and a good strategy, is we forward test it, which means we go forward now. We ask the system each day, what should our portfolio look like? And we add or drop those assets as appropriate. So just recapping real quick, and we'll talk about this more in the next session, but we have a multi-phased approach here. The first is in-sample refinement of a strategy. Then we've got a holdout date period where we, once we've found something that works decently in sample, we go forward out of sample. If it continues to work well, then it's a candidate for forward testing. And once we see something that works well in forward testing, we consider actually applying money to it. Have we got any questions for Ben?
I think we're trying to find one right now. It was asking if there are Dorsey-Wright factors or Dorsey-Wright signals for Forex.
Ben, have you got Dorsey?
Okay. Yes.
Go ahead.
Yeah, so we do track Forex, i.e. currencies. We do track futures. We track mutual funds, ETFs. So yes, there is data for those type of instruments on our website. Just go to DorseyWright.com. There's a trial link that you can click and sign up. About 21 days. It'll give you access to all the Forex charts and data points, which include the buy and sell signals and a wealth of other data such as distributions, trading bands, ratings, and things like that.
Okay, we'll take two more questions and then finish up.
Someone was asking how we optimize our portfolio. So the event analysis chart that you see, where you have the mean line going up, it shows the mean return that you're getting on each trade that's occurring. And so we will typically in our backtest equally allocate among the positions that the signals provide. And we do this so that we can reach the expectation of the event analysis chart. And so what we're trying to do is hope to achieve those mean returns, and by equally allocating among the signals that we're getting each day in our backtest is the best way that we can achieve those.
Okay, what's our last question?
We just answered that. Someone's asking what we mean by a custom strategy. This is just a strategy that Lucena has designed for a specific purpose, i.e. the strategy that we've talked about today was in the context of using Dorsey-Wright signals and how we were able to add value by looking at their signals in the context of other signals such as fundamentals.
Yeah, so following up on that, a number of clients have come to us with ideas that they think will make a good strategy, but they don't necessarily have the infrastructure or developer talent to be able to implement it. So when we say custom strategy, one of the things that means is we work with clients to build out their idea, and this is an example of how we would do that for someone interested in working with Dorsey-Wright data. So we take things from the initial concept of the idea. Hey, I think this particular factor is predictive, and carry it all the way through to discovering other factors and execution strategies, back testing, validating, and so on. So we're able to provide the the whole tamale from the initial idea all the way to deployment of that strategy. Well, let me finish up here and say thank you very much for your time, and we'll follow up on the remaining questions that we weren't able to answer here. And again, please stay tuned and listen to our next seminar, which will be in 2 weeks, and we'll talk about our backtesting methodology.
And to everyone who missed it, we will have the recording of this webinar on our website next week. Thank you.
Okay, thanks everybody. We look forward to seeing you again very soon. Bye-bye.